All right, so welcome back. Craig Foray is here. He is with Nesteggg Investment Advisors. Here this morning, we're talking about the Twitter initial public offering, which has a lot of people abuzz a tweet in the tech and business world. Craig, great to have you with us this morning. Thanks for joining us.
Thank you. Good to be here.
You know, we had the whole debacle with Facebook's initial public offering, a lot of hype over that. A lot of investors got burned on that. What do you see happening here now with Twitter?
Well, I'd like to compare the two really quickly. With Facebook, when it came to market, it had earnings, and in comparison, Twitter coming to market has losses. And not only do they have losses, but they have losses that are accelerating. So that causes me some concern. And when you, however, the Twitter IPO is 1/10 the size of the Facebook IPO. And from what insiders say from the underwriters yesterday, this offering is massively oversubscribed, which means there are a lot of people that are looking to buy this.
That won't be able to get it. A lot that will be able to, but some will be shut out of the deal, especially the smaller level investors. Is that correct?
That is correct, yes.
At least initially.
At least initially, yes.
Okay. I'm sorry, continue with your thought.
Oh, I wanted to bring up an example from the Container Store last week, because the Container Store is a widely recognized name.
Okay, another IPO.
Another IPO, correct. Last Thursday night, it was priced at $18 a share, and what that means is that the institutional investors and the people with a lot of money knew that they were going to get this at $18 a share. But Friday morning when it opened at $35. And what that means is that the institutional investors who bought at 18 sold at 35. They made a lot of money. The people who bought at 35 were the small investors, and a lot of people paid more than 36 for it. So when you hear that something doubled, just be aware of who's actually making the money here. Okay,
and I think you have some similar concerns with what we could see happen with Twitter. And I think you told me last week that for smaller investors, or for those who can't get in initially at the beginning, to maybe wait a little while until that stock price inevitably comes down a bit, corrects. And that correction could be as much as what percent?
Well, only 3% of initial public offerings double, so be aware of that. And the lesson that you can take away from this is that never pay retail. And unless you can get an IPO directly from the underwriter, I'd stay away from it. And if you really believe in Twitter and what it's going to do long term, I would say you can be the smartest investor in the room and wait 6 months, because you will be able to buy it cheaper. At
a correction, any estimate on how much of a pullback we could see from what it sells at initially? 20%, 30%?
Facebook dropped 50%.
50%.
50%.
So you wouldn't be surprised to see Twitter do this as well.
Well, I also think that the market's going to encounter some difficulty coming into the spring. So I do think that Twitter long term is probably a good investment, but you will be able to buy it cheaper.
Cheaper.
Yeah.
So what I hear you saying is wait a bit.
Wait a bit.
Okay. I don't mean to put words in your mouth, by the way, but I kind of enjoy it. All right, Craig Foray, thanks for joining us. Nesteggg Investment Advisors, it's great to see you.
Thank you. Good
okay. Quick break, more coming up.